Now, our main focus point today is about M2 growth, and this is underappreciated by many market participants, and it is about the money supply that's out there in the economy. Liquidity is a good proxy for liquidity, at least. Now, M2 is money that is in checking accounts, savings accounts, CDs, etc. Money that's easy to access, and this is also capital that banks can lend out. And so when there's more of that, they are more apt to lend, especially to smaller businesses. Now, during a time over the past few years when actually M2 growth went negative to kind of counter the inflationary impulse of huge M2 growth in 2021 and 2022. Now that came off dramatically, like I said, and so that actually benefited large cap companies because they're the ones with no debt on their balance sheet. In fact, many of them had free cash flow and cash is sitting there, and they're able to invest in their business. Versus the smaller companies, they typically be more levered and they have debt, and it's harder for them to invest in their business when the cost of capital is high and M2 growth is shrinking. And so this newfound growth of M2 likely means that mid cap, small caps should find some footing in the market versus those large cap names. So that's the big takeaway from this shift in M2 growth.